Has making lots of money on tech stocks become a thing of the past? Well, it's certainly probably a thing for the future. It's certainly a thing for the past, maybe a thing for the future. So what happens is tech stocks, famously, over the last decade or 2 decades, have grown at a rapid rate without showing any profits. So they're working off of multiples based off of revenue, but without profits. Now, when you run a business, the goal of the business is to produce a profit. People invest money, hopefully to get that money returned. So typically you would invest on a revenue basis. I've sold businesses before, and it's typically done off of a multiple of the profit. So a service-based business might go for, say, 4 to 5 times multiple on the profit. So that means that if I buy that business at a 4 times multiple on profit, then in 4 years, I would have my money back. And then every year after that, it would be a return on my investment. When you're buying an equity, it's no different. You should be buying off of a multiple on the profit. However, these tech stock companies don't have profits. So you're buying a multiple on the revenues, which doesn't seem so smart, does it? But in today's day and age, with pumping so much liquidity, it didn't really matter. And of course, these tech stocks went on to go to crazy valuations without ever producing profits. And we've seen some of these darlings like Tesla, for example, going for crazy multiples that you wouldn't see your money come back for 20, 30, 40 years, which doesn't make any sense. In order to get to that level of growth without no profits, how can you do that? How do you continue to pay your expenses while losing hundreds of millions of dollars? How do you continue to pay your employees? Oh, that's right, you do it with debt. So in order for tech stock companies to grow with no revenue, or I should say no profit, they have to continue to take on debt. So as interest rates come down, it gets very cheap for companies to take on more debt to continue to fuel their growth. We've seen over the last several years companies taking on enormous amounts of debt to even go back and buy back their own stock with debt. And then that pushes the stock price up. But going into the environment that we're in now with interest rates rising, it becomes very expensive for companies to take on that debt. Now, the problem is if these companies require debt to grow and they can't get new debt because of the interest rates, that becomes a problem. And so that's why we've seen tech stocks really get hammered over the last 8 to 10 months. As soon as the Fed started saying that they were going to pivot, they were going to start tightening, we've seen tech stocks getting smashed. The NASDAQ is down about 30%. Half of the NASDAQ is down by more than 50%. A lot of the darlings of the NASDAQ, including like Peloton and Shopify and Square, are down 70, 80%. Of course, a lot of the cryptocurrency market is down 60, 70, 80% as well. And so has it become a thing of the past? Well, it might become a thing of the past in terms of the irrational exuberance that we saw before. And I think things will become much more practical, much more rational. We'll get a return back to real growth, real profits. Eventually, we might get back to this crazy monetary expansion with low interest rates, and maybe we'll see it come back again. But for now, we're going to have to wait and see. Do not try to catch a falling knife. I'd like to wait for a trend to develop. And so that means I am not buying these tech names right now. Even if, let's say that these companies like Microsoft, Amazon, they're not going away, but what could happen is instead of trading at a 20 times or a 30 times multiple, they might only trade at an 8 times multiple. So even if the company grows, even if their revenue grows, even if they become more profitable than they were in the past, the multiple that they trade at could come down, and we may never see them come back to these highs. So be careful out there.